Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk a little about trading, investing, and the probabilities, luck, and all of that stuff. I was on Twitter, was going back and forth between a couple of people, and they were saying that I didn't understand the markets, and I don't know if they understood my argument. So I'm going to describe the argument. I'm going to show you data on some things of what I look at, how I discern certain things in the markets. This is a game of chess, not checkers. And um, it is highly important to understand that it's important to understand what is important, and it's important to understand what's not important. There are leading indicators and drivers of some of these things, and it's putting together a large puzzle. And what you're doing in investing is nothing is you don't have control over the outcome, which means there is a degree of luck in the outcomes depending on what you're looking at. So if you're looking at a short-term outcome, an outcome is a result of something. So if a price moves up or down, that is an outcome. And in investing, you don't have solutions to problems. You have predicaments. Predicaments have outcomes. And we put in place strategies to handle the outcomes. Hopefully that makes sense. So any one event in this system is based off of luck. Luck because we don't have total control over the outcome. So you can go into it, you can have a high probability bet and still lose because you don't have direct control over the outcome. You still have a degree of luck in the system. Now, when someone makes, and this is highly important here, if somebody makes a claim on a short-term price movement and they get the price movement right, that doesn't necessarily validate the claim. I'm going to say it again. If you make a short-term price prediction and the price prediction happens to be right, doesn't mean that it validates the reasons for why it doesn't mean it validates the reasons that you think you're right. And that is exceptionally important. So if someone comes out and says, I think a recession is going to occur, therefore all commodities will fall, I would say that it would be lucky if someone were to make that prediction and all commodities fell, because there are so many variables impacting every single commodity that you would have to have an alignment of a lot of variables. Weather can impact commodities. Weather is completely outside of the control of people. So you can have the right market conditions for something to happen with high probabilities and still not get the desired outcome. There is a degree of luck because you have no direct control over that outcome. The way that traders and the way that investors overcome those outcomes, because we don't control the outcome of the price moving up or down, that is the opinions and sentiments and everything of all of the traders in the world interacting with each other and also interacting with external factors in the world, whether it be weather, whether it be whatever it is. So any single event requires luck to be right, because luck is the price moving in your favor, because all we have are probabilities. And this is just statistics and a little bit of logic. Now, a trader is going to work off probabilities. If you have a higher probability, the better you are, the more skillful a person is having a better desired probability of outcome. So the better you are at trading and the better that your strategies are employing, you are making more money on each trade that is a winner, you're losing less money on your losses, and your probability of success should be higher than someone else. That will really get you more money. But any single event in that series of events is based off of a degree of luck. So he or she is making their money by replicating a good strategy using probabilities. But any single event within that is luck, because you need so many things to align for you to be successful. Just because it's a high degree of probability doesn't mean you have the control over the outcome. It requires luck. And I don't think people understand that. What I developed over the thesis is basically the highest probability bet that I could find. So I'm maximizing my probability. And what I did is I looked through history and looked at the probabilities of success given certain market conditions, ratios, and technical analysis. On a longer term time frame, what you're charting is the fundamentals of a stock or a company. The fundamentals move the long-term price. The short-term price, anything can move it. That is why it requires a high degree of luck to be successful in any single event on a short-term price prediction move. If you think it's going to go higher, your probability of success in the short term is far lower, because any sort of variable can impact the movement. On a long-term time frame, other variables impact the price movements and are, quote, fundamentally driven or driven by market conditions. So the highest degree of success in the markets that I could find is to take a long-term approach where the fundamentals are what drive the stock up or down, and the market conditions drive that stock up and down. The market conditions are inflation, deflation, which is basically the business cycle. And again, the business cycle and the size of that cycle is entirely dependent on multiple factors. It's dependent on how much money's been released into the system. It's dependent on how large the demographic and how fast that demographic, the rate of change, comes into play. It depends on the response by Federal Reserve banks. It depends on how fast we can build new homes. There are a lot of variables in this mix. And all you can do is prepare yourself for the highest degree of probabilities and place yourself in large asymmetric bets where you win a lot of money when you're right and you lose a lot less money. That is how you win in the markets. Your time frame doesn't necessarily matter. But those who play on the short term have to be extremely strict with their strategy. On the long term, you can be a little bit more messy and not follow it as much and have a lot less degree of interaction with your investments than you do on the short term. But any single event in the short term, with as many variables as there has a degree of luck. And even on the long term, it has a degree of luck. Because I don't control if we have earthquakes. I don't control if a hurricane comes. I don't control if a facility goes down that's important to, like a liquefied natural gas terminal, which is important to linking up the American natural gas price and the international price. And that's what I'm going to go over here and give you an example. And I'm going to show you things that are out of the control of the investor, but we're basing it off of probabilities of success, and why I'm still long all of these things. So let's go over it. I'll give you some examples here that I've got in the back here. So I've got crude oil here. What I have is the 10-year yield, TNX, in the orange line. In the crude futures, the green and red line is light crude oil. There is a high correlation between the 10-year yield and the price of oil. The price of oil is the number one commodity in the world. That commodity and the price of that commodity, since it's the number one commodity, determines the 10-year yield to some degree because the 10-year yield is impacted by inflation. Your number one commodity and the price of that number one commodity determines your inflation. And the commodity, oil, is determined by the supply and demand of currency units in circulation. Because if you have more currency and more wealth in circulation, that requires more energy. And that is dependent on the number of loans in the system and the size of those loans. It's the volume of loans. Volume is the size times the number of transactions. That is your volume. And when we had all of that money in the system, it was a pressure for oil to go higher. And the pressure of oil going higher puts more pressure on interest rates to go higher. What I have here is that correlation between these two. You can notice that when oil and the 10-year yield were dropping together, they bottomed at the circle. And now as oil rebounded, the 10-year yield also rebounded and is going up with the price of oil. What I am showing in here and what I want you to think about is that there is a correlation between the 10-year yield and crude oil price. In order for the Federal Reserve to fight inflation, they also have to fight the price of oil. Raising interest rates will not stop the continued inflation into the system unless they stop the price of oil from moving higher and they stop the price of other energy inputs into a system. The reason Germany's CPI is so high is because of their energy prices and the energy, basically the policies that they've put in place is a resultant of their consumer price index going so high because of the energy prices. You choke the energy in an economy, your inflation rates go up. Think of the 1970s and the market conditions for that environment. We're talking market conditions, probabilities of outcomes. The way that the 1970s played out was we had a liquidity event where a demographic came into home buying years and flooded the system with cash. That cash put everything into shortages. That is inflation. It's cash being generated at a faster pace than the supply of goods and services. That put pressure on oil to go higher. But we had a constraint in oil where oil couldn't go higher, and it lopsided I call it lopsided. It increased the price of oil at a rate faster than if it was an unrestrained oil production. So since there was a restraint in oil production, which was peak oil in 1970, the price of oil went up more dramatically during that time frame. That dramatic increase in the price of oil led to higher inflation rates in the system. The higher inflation rates in the system led to higher interest rates in the system because more people sold bonds because of the inflation rate. Those bonds being sold was a increase of money going after other goods instead of bonds. And it made the problem worse. It's a feedback loop. But I'm going to show you a couple of things of how they're trying to manipulate the 10-year yield and how they're trying to manipulate the price of oil and inflation. So someone made a claim on Twitter, and this is what I mean by luck in the short term. His claim is that natural gas went lower because of fears of recession. He made his claim that we are going to have a recession and that the fear of recession is the reason that natural gas fell. Well, I said, no, your reasoning is wrong on the short-term price movement. The reason this fell was Freeport liquefied natural gas plant. That blast adds strain to the global supplies. That blast stranded American natural gas in America. It could not be exported through liquefied natural gas plants or through the plant onto the world market. So what that means is that the American natural gas price disconnected from the world price. And I can show you exactly what that looks like. We had the share price, we had the natural gas price disconnect, and it went lower. Now, here's the thing. We were breaking out to the upside of a long-term accumulation cylinder. We don't know the exact reasons why the Freeport LNG plant went down. They still don't know. They said it was built at a buildup of pressure in the pipe. Yeah, sure, okay. But it happened right at the exact moment we were breaking out. Sheer coincidence, right? We need a lower inflation rate. And if natural gas broke out, this is going to have an impact on the inflation rate because that is a feedstock of energy into the system. Natural gas prices going ballistic in Germany is a reason that their consumer price index is so high. So it just so happened that we, right at the breakout, had an LNG plant, which is the largest plant of the LNG terminals, happen to have a problem right on the breakout. We went back lower. So someone made the comment, well, it's because of the fear of recession. My opinion is that the LNG plant going down and unable to export is the reason that this went lower. And what's weird is this basically was coming to a point with some degree where somebody knew about this, which makes me think that this could have some sort of, that someone had some control over this outcome. Now, this is coming on back. This is the world markets. The explosion happened and the world markets went vertical at the same time that the Freeport LNG plant went, when it exploded, that American price went down. Do you think that this is a random chance that this went lower and this went higher, and the linkage between American natural gas and the exportation of it, that we had this divergence in the markets? I think that there's zero probability that someone making the claim that the fears of the recession was the reason that the American price of natural gas dropped. If that was the case, we should see an accompanying price drop in the natural gas in Dutch, Europe, and Asian. And they all went higher at the same time that this went lower right after the LNG plant blast exploded. Therefore, by using the information and using logic that the plant explosion was the main cause of the reason of American natural gas to go lower and the price of natural gas in other areas of the world to go higher, because the linkage between American natural gas and international price was broken by 20% of our export LNG potential. And the reason this is important is because when that LNG facility goes back up later in 2022, the link becomes linked up again. I think there's a high probability that when this linkage goes back up, that we break this accumulation cylinder to the upside. That's why it's important to understand these linkages. Another thing, weather cannot be predicted with 100% certainty. There's also weather-related reasons that natural gas is going up. We have scorching hot temperatures across America, leading to higher natural gas consumption. In the short term, that cannot be predicted. I cannot predict in 2020 that there's going to be hot weather in 2022. I cannot predict that a potential hurricane is coming this year that's going to impact the natural gas price. But I can say with certainty that natural gas inventory levels are low in America and that natural gas inventories across in Asia and Europe are also very, very low. That is a fact. But it doesn't mean that the probability of this outcome of having it move higher, that the high degree of probability that natural gas in America will go higher because of the LNG terminal coming back into operation and the discrepancy between Europe's price and Asia's price and America's price, that high degree of probability doesn't mean that it will play out with 100% certainty. There is a degree of luck in this viewpoint of it actually playing out and working. It doesn't mean it's in the bag, but it's as high as a probability as I think you can get in the market with what's available in the market for potential investments. Now, here's the price of oil. I showed you the linkage to the 10-year yield. The 10-year yield moves the price of oil. I told you that they must control the price of oil to get the inflation rate down. That is how they're going to control the inflation. That's how they're going to try to attack it. At the top here, someone made the claim that the fears of the recession was the reason that this fell down. I told them no, and the reason this is important is because the fear of recession in a free market wouldn't have overcome the price of oil, in my opinion. What they did is on the world market, they released, the US and 30 countries committed to release 60 million barrels of oil from strategic reserves to stabilize global energy markets. They did that at this top to slow the price move of oil down, to slow the inflation rate down, and to slow the interest rates from moving up. The reason they did that is because the interest rates going up were going to break the currencies of a lot of these countries. They are in there. They quote, have fragmentation in their markets so that they could create unlimited amounts of money to save certain currencies and areas of their systems. This could potentially be war of Eastern countries versus Western countries. And the way that you break a highly indebted system is you attack the energy supplies where energy and the interest rates are tied together. Energy prices blows up your inflation rate. Your inflation rate blowing up increases the pressure, the selling pressure on bonds, increasing your interest rates. Your interest rates is what's going to break your currency because you have to create money to cover the debt payments in that system that is highly indebted. It puts you into perpetual inflation, which could lead to hyperinflation with time. What we have here is they released oil. They released more oil throughout here as well. All through here, they were releasing more oil. They were coming out with even more strategic petroleum reserve releases in this system. Now, the bullish engulfing pattern here, we were in a downward channel. We hit a bullish engulfing. We have higher lows that happened, and then they break to the upside. This area here, we have a downward channel. We have a bullish engulfing right here in the red that I'm pointing to. We came up. We had less selling pressure. We had a nice hammer pattern, and we were breaking out to the upside of this channel last trading session. And it just so happens when we're trying to break out that they release that the U.S. is going to sell an additional 20 million barrels of oil from the strategic reserve. What I am seeing here is that each one of these releases is strategic by their design. They know what I know. They can read charts just like me. They can read sentiment. They have economists and technical analysis chartists on their team developing strategies of when to release news to manipulate the prices as best as they can in the short term to keep this all low and together. They're doing it with precious metals. They're doing it with oil. They're doing it with natural gas. They are trying to lower the inflation rate to control all of this. Remember, the 10-year yield is also tied to this. U.S. government bond 10-year yield. We are now throwing a pattern of a shoulder, head, shoulder that everyone is seeing in the markets. They're saying, well, this could potentially go lower. This is a head and shoulders pattern on the 10-year yield. But what is actually happening in the oil markets? The oil markets are highly tied to the 10-year yield. They are creating a head and shoulders pattern based off strategic petroleum releases and the manipulation of the price of oil. Is this a valid outcome of the 10-year yield? I don't know. That is where it comes to in the short term. Because I know for a fact they're manipulating this price. We can see it in the strategic reserve releases. Now, the strategic reserve releases are only a short-term band-aid to a longer-term problem. When they run out of these releases, then the price of oil will snap back higher and probably move at a much faster pace because we've been relying on inventory releases over this summer, which means next year we are going to be in the tightest markets with no inventory in these strategic petroleum reserves than we've ever been. Ever. We are going to be at the mercy of the pumping capacity of the world with the lowest amount of inventory. Does that sound like a good environment for an oil investment? Yes, it does. Now, if this is a legit pattern, we could see in the short term, which remember, a degree of luck and the probabilities are lower of a move lower. A move lower in oil, a move lower in commodities. And that the fears that are being driven by all of this, it could go lower. Now, I'm not taking that bet. I'm going with the higher degree of probability, taking the long-term strategic approach, not the tactical approach of reacting to the market. I'm taking the strategic approach that there's an imbalance in the system, that they're trying to manipulate these numbers through strategic petroleum reserve releases, and that I'm taking the higher degree of probability bet as a strategy to play the long game here and accumulate on pullbacks. And that oil prices will go higher, inflation will go higher, and that this is all a temporary band-aid of trying to slow the price movement and slow the inflation rate down. They are in the background trying to slow the rate of the M2 money supply growth. They're trying to buy time. That is what they're doing. Now, looking at the Case-Shiller U.S. National Home Price Index, I'm going to talk about this as well. We've had a pretty large move. What this means is that we've had a large imbalance in the market. We've got a large imbalance of supply and demand, and there are a bunch of factors that impact that supply demand. Interest rates do impact the supply and demand and the affordability. That can impact the number of available buyers at certain price points. But it doesn't solve the problem of supply and demand. What we would see if we had a supply-demand problem and the affordability of home prices get too high, we would see an explosion of rent prices go up, which we are seeing, which means that there is a shortage in the system and that people are straining to afford to purchase a house themselves, and that the number of available homes in stock are low. Now, people are saying that this is a bubble. Is it a bubble? The answer is no, not at this time, because we do not have inventory to call it a bubble. They are speculating that the inventory is going to go to high levels and that prices will 100% turn around and go down. I will fight. I will give an opposing argument that we are not in a bubble. We are not in a bubble, and this isn't necessarily my belief. I'm just telling you an opposing argument. An opposing argument is that we are going into a highly inflationary environment over a time frame of the next 10 years. And that high inflationary environment is going to put upward pressure on home prices because the largest sum of money needs to rotate out of bonds worldwide. The largest sums of money in bonds for those investments have to park their money somewhere. Where is that money going to go? And if it's not going to go into stocks because of an increasing interest rate environment with high inflation, the money has to go somewhere. This then becomes a bigger problem than just supply and demand of affordability in the system like it has been in the past 40 years. The paradigm has shifted. It has changed. Bonds don't work anymore. If bonds don't work anymore and that money rotates out, and stocks don't work anymore and that money rotates, where is it all going to go? Those markets are far larger than the commodity market and precious metal market can handle. So that money is going to leak over into real estate because of the market conditions. That is a bull case for real estate. Another bull case is that they can't continue to increase interest rates forever because it will be too inflationary. What does that mean? Higher interest rates are going to be inflationary because the bonds that are going to be created when the money is created will have to be purchased by the Federal Reserve, which is inflationary, which means they're going to have to pump the balance sheet on the Federal Reserve's balance sheet has to continually expand for them to hold interest rates down so that the government can afford its interest payments, which requires an inflationary resultant of money printing and them buying bonds to hold interest rates down. That's QE. And that lowering of the bonds is going to be inflationary, which then means that more money will rotate into other assets. It's a complex dynamic that hasn't happened in 40 years. And everyone's comparing it to the past 40 years. It's a paradigm shift, guys. It's different. I'm not saying that this is necessarily going to go higher. I'm just making arguments that it could go higher based off of the market conditions and the imbalances in the system. A lot of people are showing this on Twitter. Months supply of new houses. Oh my goodness, this is what it was in the bubble. Look, we have a bubble here. This is the month's supply of new homes. And everyone shows this. I'm going to tell you a difference between this time and this time. These homes here are completed new homes. These are available to buyers. These homes are not available to buyers. These are the homes that are in the system ready to make inflation for you. The available homes that are completed, new houses for sale by stage of construction, completed, are super low. Yes, they're going up, but this picture is far different than this picture. These are completed homes. These are the completed homes of new houses that went into the market. We don't have completed homes in this market. We have a lot of homes in the stage of new builds, but they're not completed and ready for sale. The reason the Federal Reserve is raising interest rates so fast is they need to stop this from happening. These are new loans into the system if these houses get completed. They are getting transferred and purchased in the system, and that's why these are so low. Everyone's buying the new homes that are actually completed. They are already sold. This is a completely different scenario than this scenario is because of the homes being completed and sold versus just what's in the pipeline. This here, if they continue to sell these homes, is future inflation. This is future inflation. This is what they know. They need to raise the interest rates as fast as possible to stop these from being sold. They need to slow it down. Then they slow it down using the strategic petroleum releases in oil. That is how they're controlling it. And I don't know if this explosion has any sort of militia, that it's being manipulated behind it, like it was a planned explosion. I don't know if it was planned or not, but it's a sheer coincidence that this explosion happened at the same time that they released these barrels of oils out, or close to it. Sorry, that was a little bit after. This is in March 1st, 2022. This was in June that it happened. I don't know if there's some sort of, if that happened because of it. I don't know. But that's what I've got right there, guys. That's what I wanted to share and have you guys understand. These are all interconnected, and there's reasons they're doing it. I am showing you the motive behind it. Call me a lawyer for some reason, or an investigator, or an analyst, whatever it is. You find the motive, then you look for that paradigm and see if the data can support it. The housing market isn't as dire as what most people think. That's my opinion. We have to see far more inventory come back up, and it could happen, and it's going to take some time. I'm just showing you the linkages between everything. I don't think they have this energy problem, this crisis solved. I don't think there's a handle on it. You end paradigm shifts with inventory. The inventory hasn't been fixed. The liquidity is still coming into the system and is in the system. Now we have to see how it plays out, and I'm taking my bets based off the probabilities of the market conditions ratios, which is a high probability bet. Short-term outcomes are based off luck. There is a degree of luck. Probabilities determines your success. That is the number of outcomes tried over many times, and your success is the probability of your strategies and your risk reward that you took in the strategy. So it's risk reward multiplied. So it's the number of favorable outcomes, the size of those outcomes, and the size of the outcome of being wrong multiplied by your probability of success. But any single event is based off of luck. And because all we have is probabilities, we have no control over the outcome. And that is what investing is all about. That's why we develop the strategies. And that's why we have a handle on risk. And that's why we take certain time frames. If you guys like this analysis, give me a thumbs up, subscribe to the channel, subscribe to the Platinum membership below. I'll show you how to play the natural gas disparity there in oil, what the best plays, in my opinion, are. They're all on the website. I also do a lot of financial education. I talk about ratios, technical analysis, and I also talk about market conditions for the probability of success to be maximized in your favor. Does it require a degree of luck to be right? Yes, everything does in the markets, because we don't have a control over the outcome. And there are things that can align in the natural gas market where we could still get 10, 20 baggers, 30 baggers out of the price of natural gas. One scenario, just to let you guys know, that could happen is that the LNG terminal comes back online, which connects us to the overall markets. At the same time, we have a bad hurricane season, and it comes through and wrecks our natural gas production. Natural gas would then converge to the world prices at the fastest pace that anyone's going to see in a blink of an eye. That is weather related, which is not a controllable outcome. That is also dependent on the LNG terminal coming back online later 2022. If you get these two things to align, you could see natural gas prices in America be over $20 a million cubic foot. Like this. Now, I'm not predicting a hurricane that's going to do that. We can't predict it. That is based off a degree of luck. But the probability exists because we're coming to hurricane season at some point. We also are at very low inventory levels in America based off of weather, the hot weather that we've had this summer. That is also a degree of luck, a degree of things aligning that we don't have control over it. Now, if this LNG terminal comes back online, we have hot weather, which is drawing down our inventories, and we have a hurricane season that's active. You could see a ridiculous price move for some period of time. All right, guys, that's what I've got for today. Hopefully you enjoyed it, and we'll catch you next time. This is Finding Value.